Singapore, yeah. So we should listen. Hello, sir. You too, hi. All right, so welcome to the live broadcast. We are solving a question on consolidated financial statement. If you join the broadcast, let me know where you are watching from and comment below with your question, because in addition to looking at what is in class, I will also be answering your questions from the comments. So put below your comments and let me know where the heck you are watching from. So let's go. You have a question? The agent? You don't have the agent? It's with the Bible. Bible, sorry. So the Bible. Do you have Bible? If you have Bible, because it was together, it's like this. One question like this. So comment below with your questions, and we are going to solve a question of consolidated financial statements. Join the broadcast because I'm going to read through. Then after that, I'm going to leave a link in the description so you can download the question and it will help you to watch the video as well. So you comment below with your questions. Have you seen it? So you comment below with your questions. This is Bible. All right. I know what you're screen. As I said, believe it or not. You take it, you go. Can we go? Now, the requirement of this question for 20 marks is we should prepare the consolidated statement of financial position for Dagent Co. as at 31st March 2016. Now, as always, before we begin the journey, we must look at what we need to do. As they said we should prepare the statement of financial position, what it means is that the workings are going to be, we go to group structure, we come to the net asset of the subsidiary, remember that? We come to the issue in relation to maybe fair value, fair value of consideration transferred may be there, group retained earnings may be there, and then your NCI value may be there. So these are the core workings we're going to be looking at, and from the question, we'll be following the workings in that suit. So let's go through it. On 1st January 20X6, Dagent Co. acquired 75% of Latrice Co.'s equity shares by means of share exchange of 2 shares in Dagent Co. for every 3 Latrice Co. shares acquired. So, as I say all the time, you don't read all the question, you build up or you do the workings as and when you are reading. So from there, I can do group structure. So if I'm doing my group structure, the parent is Dagent Co. Then I have my subsidiary as Latrice or Latrice Co. Then I have my non-controlling interest. How many shares are we acquiring? 75%, so NCI is 25%. What is the date of acquisition? Very important. 1st January 20X6. Then what is the year end or reporting date? 31st March 2006. So how long are we doing here? 3 months. That is very important. It means anything about the subsidiary, we are going to take only what? 3/12. 3/12 in relation to that. Okay. So that's the first aspect. I can do the group structure. Then the way the acquisition was financed, they said first by means of share exchange. So from there, I can do fair value of what? Consideration transferred. So look at what is happening. The first thing is that there is a share exchange. What's the policy for the share exchange? 2 shares in Dagent Co for every what? 3 shares acquired. Okay, so if we are acquiring 75% share, what is the total share capital of Latrico? From the balance sheet given? 20,000. Please note that all the time, look at the nominal value here. Last semester, like I was telling you the last time, it was 0.25. And students were saying that the shares they bought was more than the shares here, Daddy. You always must look at the number of shares. In this case, it is 1. It means the number of shares is still what? 20,000. So 75% of 20,000 times 3 over what? Hey, we give you how many?
2 shares.
2 shares for every 3. So it's going to be 2 over 3. Make sense?
Yes.
And remember, I told you that anytime there is share exchange, you use whose share price? The parent share price. Now, as at now, we've not read the parent. Yeah, you want to ask?
You said last year sitting.
Yeah.
The share price given. In
the nominal value there, instead of the $1 was 0.25. So in that case, you need to get the number of shares. So it was 50 million up, share capital 0.25. It is an open number of shares now. Number of shares will be 50 over 0.25, and that will be 200 million shares. You get the idea? Okay. So that is it. I don't know the share price now. I'll pause there. Let's go. Then it says, on that date, further consideration was also issued to the shareholders of Latreco in the form of $100, 8% loan note for every 100 shares acquired in Latreco. Okay, so that is issue of loan notes. You remember it is one of the components of our consideration. So issue of loan notes. So 75% of 20,000, and we are giving them a $100 bond for every 100 share acquired. Does it make sense?
Okay.
Does it make sense?
What about the percent?
Which percentage?
8%.
That is the interest rate on the loan notes. So that will come in finance costs later on. I get it. So the coupon rate on this loan note is 8%. So that will come. So I could put it here as issue of 8% what? Loan note.
Okay.
But the 8% is the finance cost. Is there, right? Okay. So arithmetically punch this out and let's see what we have.
Share for everyone.
First escape.
I have 15,000.
15,000, okay. So that is the loan notes. That is the loan notes. Now, let's continue. Then it says, none of the purchases consideration, TNA, nor the outstanding interest on the loan note as at 31st March has yet been recorded by what? Dagent Co. Remember, once they have issued a loan note, they are supposed to pay as a finance cost. So quickly, I put that up here. So this could be 1, this could be 2, this could be 3 for my finance cost on the 8% loan notes. Now, what is the coupon rate? 8%. The nominal value is 15,000. So it's going to be 15,000 by what? 8%. Name of how many periods?
3.
So 3 over 12. What we got?
300.
300. Now, how do we treat this 300? Listen carefully. This 300 is a loan note. Since they have not recorded it, it means we need to take it to group retained earnings. And we'll be deducting it in group retained earnings. Then we'll also take it into what? Current liability as an accrued interest. Does it make sense? Because they've not recorded it, they've not paid it. So again, from the preamble, This is the workings I can do so far, but I'm not done with the preamble. Let's go. At the date of acquisition, the share price of Degent Co. and Latre Co. is $3.2 respectively and 1.8 what? Respectively. So quickly, since I have the share price of Degent Co., I can now calculate my share exchange value. So what is the share price of Degent Co.? 3.20. So let's multiply up and let's get a value for the share exchange. So 75% of 20,000 2 over 3 by 3.2.
So all this happened on the acquisition.
Yes, this is the financing of the acquisition. This is how the acquisition was financed.
Okay. So when do we start using the figure at all? Or it should
say the usual whatever workings that they throw at the post-acquisition issue is going to come. But when we are dealing with fair value of consideration transfer, we don't deal with the period of acquisition. We consider how much transpired at the date of acquisition.
So if I understood you well, it means that the post-acquisition, we use the...
Yeah, the 3 over 12. And looking at the interest is not full year, but it's 3 over 12. Because the interest will be the date of acquisition to the reporting date. What do we have? 13,000. 32,000. So adding up, the fair value of consideration is going to be 47,000. Okay. So that's the fair value of consideration transfer. So from the preamble of the question, you see the workings I've done. That's the workings I've done. And that is how I want you to go by consolidation. Don't read the whole question. You will be overwhelmed. Just go bit by bit and you'll be perfect on the job. Okay. So once we are done with the preamble, we go to the footnote straight up and deal with the footnote to see what's happening in the footnote. So let's go to note 1. At the date of acquisition, the fair value of Latreco's assets were equal to their current amount. However, Latreco operates a mine which requires to be decommissioned in 5 years' time. No provision has been made for these decommissioning costs by Latreco. The present value, discounted at 8% of the decommissioning, is estimated at $4 million and will be paid 5 years from the date of acquisition. That is the end of the mine's life. What's happening here? Decommissioning cost means decommissioning cost. Right? It means environmental cost. Okay? So at the end, meaning probably the company is a mining company or whatever. So for environmental cost, in accordance with IAS 37, we must what? Provide for it. Because there is a present obligation. Now, what is the double entry? The double entry is that we're going to be debiting property, plant, and equipment and crediting provisions. You remember that? Then we depreciate the provision as part of the net asset of the company. Then the provisions we unwind. You remember the unwinding thing and the IAS 37. So this workings has not been done. Now let's tell the examiner we are all figures are in thousand. So the total figure is how much? 4,000. Now, how much discounted at that? So we will debit PPE with what? 4,000 and credit provisions with what? 4,000. Now remember, this hasn't been included in the records. So what does it mean? It means that off the bed from here, I can structure my net asset out. So I can do 5 year and let me do net assets of the sub year. So that I can fuse this in. So at acquisition, at what? Year end. What do we bring? Stated capital. How much? For the subsidiary, 20,000. 20,000.
Yes.
Retained earnings. How much? 19,000. 19,000. How much profit did they make for the year?
8,000.
Now follow me carefully. The profit, the whole profit they made for the year, remember, after our acquisition till the year end is how many months? 3. Meaning they had operated 9 months before we acquired them. So, in relation to the profit for the year, what is going to happen is that I say the chim, now 9/12, ever at acquisition, now 3/12, echo at the reporting date. I don't know if you understand. Now, the whole profit that we make for the year is 8,000. Now, if we are dealing with the profit for the year issue, what is going to happen is that they had operated 9 months before we came. It means that if we are dealing with the date of acquisition, they had made some profit before we what? Acquired them. For that reason, 9/12 by the 8,000 has to be what? At acquisition. So what do I have? One will say, assuming it was a full year acquisition, and that the whole 8,000 would have been here. Do you know that? The whole 8,000 will be here, and nothing would have been here. Now, because of the fact that we are acquiring them for only 3 months, we will have to bring what? 9/12 of the 8,000 here. And that's how much?
6,000.
6,000.
If you are going to use 3/12, why is it 8?
So 3/12 there, how much do we have? Are you following the picture? So the idea is that now their profit for the year, the total 8,000 will be added to their retained earnings. I hope you know that. I hope you know that. So the total 8,000 will be added to their profit for the year. Now, why did I start with this when I was talking about this? This is a decommissioning cost. They have not accounted for it. So we need to account for it. So look at it. This statement there is just a fair value adjustment. So we will bring the PPE component, which is adding how much? 4,000. Then we bring the provisions component, which is subtracting what? 4,000. Be careful. And you say it's cancelling out. It's a double entry you are doing there. Why? And the same thing will go to the year end. 4,000. 4,000. Now, immediately there is provision, as I said, there has to be what? Unwinding. So first, let's deal with the finance cost. What was the discount rate they used?
8%.
So 8% of 4,000 by 3/12. What do you have? 80. Now that's a finance cost. It will be deducted. Remember, I told you that the unwinding on provision, how do we deal with it? We debit the income statement with the 80 and do what? Credit provisions with the what? 80. So now if you go to the statement of financial position, that is a consolidated statement of financial position, this provision for environmental costs will go to non-current liability, and it will be the 4,000 plus what? The 80 to give you 4,080. Does it make sense? This is the double entry. This is the double entry. Then, on this PPE, it has to be depreciated. So, depreciation on the PPE, that is going to be 4,000 over, the useful life of this is 5 years. So, over 5 times 3 over what? 12. And you say, 200. No, it's not done yet. That one too has to be deducted. Now listen carefully. Listen carefully. I've told you how you treat the provision. Now, the fair value adjustment also, the 4,000 minus 200. When we go to the statement of financial position, remember, it will be added because they've not included this as part of their assets. Yeah, just cross the road, you'll get some for there. Yeah, just cross the road, you'll get some for there. Where you are light, no? Yeah. Yes. You understand the finance cost treatment on the provisions? It's according to IAS 37. When there is decommissioning of future environmental costs, we discount it to present terms. And no more than 4,000. So what is the double entry? We debit PPE because it has to be added to the property, plant and equipment and depreciated. And we credit provisions. It is our entry, let's say. Now, anytime there is that decommissioning cost or that environmental cost and we calculate it in present value, we need to calculate the unwinding. Because every year we'll be putting 80 down. So that by the 5th year, it will add up to the money we require to be able to what? Do the decommissioning. That is why, and it's only 3 months. It's only 3 months. That's why we need to do 3/12. Then the PPE, as I said, you debit PPE. And every time you debit PPE, it means you need to calculate depreciation on it. So the depreciation on that, the life is 5 years. So it will be over 5, but we are dealing with 3 months. So 3/12. That's the treatment. So from the note 1, this is the workings we can do. From note 1. It is the principle here, IAS 37. That's coming to town here, and you must understand how to do this treatment very well. Note 2. The agent's policy is to value non-controlling interest at fair value at the date of acquisition. Lettery Co's share price at that date can be deemed to be representative of the fair value of the shares held by what? The non-controlling interest. Or see, I use the share value. Share value. So I have 1, 2, 3. This thing right here is not working. It's not working. I just used it to explain the double entry for this thing. So let me still make this guy 4. But I won't claim because maybe you're going to write it. So 5. Fair value of non-controlling what? Interest. They said we should value it using what? The share price of what? Nhyira. So how many shares do they owe? 25%. So 25% of 20,000. What is the share price of the subsidiary, Electrical? 1.8. So multiply it for me. Let's see what we got. $9,000. That's it. $9,000. Okay, so that's their workings too. We are solving a question on agent's code. Let's go to workings 3. That is intra-group trading. Okay, workings 3 is intra-group trading. Then I'll leave you to write. Then we continue. The inventory of Latrico. Now listen to the language here very well. The inventory of Latrico includes goods bought from Agent's Co for how much? 2.1 million. It say closing inventory now for Latrico. It includes inventory of 2.1 that they bought from what? Dagent Co. Dagent Co applies a consistent markup on cost of what? 40% when arriving at its selling price. Okay. On 28th, so who is selling to who?
The subsidiary sale to the parent.
A liar has a tail.
You see the inventory of includes bought from, okay, the parent is selling to
Parent is selling to the subsidiary. The reason why I ask that is that so that if the subsidiary is the one selling, the provision for realized profit would have what? Been here. But since the parent is the one selling, provision for realized profit will go to group retained earnings. On 28th March 20X6, Dagent Co dispatched goods to Latreco with a selling price of how much? And so have not been included in the above inventory at 31st March 20X6. What did I tell you about goods in transit? We push it into the account. So number one, the inventory you see here, when you bring the parent figure, the subsidiary figure, you will add what? The 700 to it. Does it make sense? Good. Now, it means that working 6, if I'm going to be dealing with the intra-group trading, the provision for unrealized profit will be calculated on two things. The unsold unit of how much? 2,100, and the goods in transit of how much? 700, making a total of 2,800. So that is the figure on which we are going to be calculating provision for realized profit. Now, what is the issue there? 40%, right? It is a 40% I
markup.
Yeah, markup. So we have the selling price and we have markup. So do we do KG school or we do professional school?
Professional.
Professional. So 40 over 140. So we go. What you got? Punya.
Point something, that's right.
0.071.
Hey.
How? You guys are not seeing here.
Oh, yeah.
700 divided by 2.
Yeah, it was supposed to be 3,008 times.
What are you doing? Are you doing 200?
No.
2,800?
Times.
Hey, there's a more punchy for the
800.
800. So that becomes the provision for
You
realized
don't
profit.
take care because
Because,
2,100 plus 700 is 2,800. You immediately 700 over 2,800 times what you
Okay. So is this total that is coming here?
Yes.
So when you are writing, you write more. Now, how do we treat this 800? You debit inventory, credit what? Group retain. You debit group retain earnings, you subtract it from group retain earnings and credit the inventory, meaning you subtract it from inventory. Stay inventory, meaning you subtract it from inventory. Stay inventory, meaning when you bring the parent, bring the sub, add the group retain earnings, you subtract what? The provision for realized profit. The inventory you see there. When you go to the statement of financial position, when you bring the parent, you bring the staff, you add the goods in transit, 700, then you subtract what? The provision for realized profits. Make sense? Alright. But we are not done. There is a last paragraph there. At 31st March 20X, Dagent Co's record showed a receivable due from Latreco of how much? 3 million. This differed to the equivalent payable in Latreco's records due to their what? Goods in transit. My body's almost exhausted. I want to see. Where? Here. So let me adjust it here. It's a very short thing. Now, Dagent is on one side, Letry is on the other side. Who is trade receivables? Dagent, right?
Yes.
How much? I'll say 3,000. Anna, trade payable, no, latry. We don't know it. But there is a goods in transit of how much? 700. Or say, the reason why they are not the same is because of the goods in transit. It will be captured all the time, no, meaning have a balance it off to be 3,000. 3,000. So the balancing figure for trade payable is what? 2,300. What does it mean? It means when you go to the consolidated statement of financial position, when you bring trade receivables, the parent and the sub, you will subtract what? 3,000. Then when you go to current liabilities, parent and the sub, you will subtract what? 2,700. Sorry, 2,300.
Please come again.
The reason why we must deduct these things is that at the end of the day, this will be the obita. So when you go to current assets, trade receivables and the current assets, you bring the parent, you bring the sub. Now, Digit has trade receivables of 3,000. So you subtract it. Then when you come to current liabilities, you bring parent and sub, and Latry has a payable of what? 2,300. So you subtract that one as well. So that's how you treat these in the statement of financial position. So you can put it down and then let's continue.
There was some questions.
That you want to ask?
There was some questions.
Oh, okay. Let me just see. Class now. We are also OG Apple.
They're coming to know.
But the videos are much. So it's not copying.
Hey. You know what I wanted to find out is, I think the best way is they say pro rata basis. That they use. So my point is, when do you use a 3/12 if it's not applied fully?
So you use the 3/12 in dealing with fair value adjustment.
Not only to this particular question. In a question, you read they applied it, maybe it was not a full year, 9 months, 10 months, whatever be it. When do you start applying that?
You start applying it if it relates to any transaction relating to the post acquisition. One point is the fair value adjustment. Another point is if you are dealing with finance cost. Another point is if you are dealing with depreciation. Another point is if you are dealing with share of profits. Because if you are now sharing profits, you don't bill full year. Because remember, you didn't your full year profit.
Because with this cost from here, 75 and all those ones, I know it has to do with acquisition. But when you come here, it says on that date, further consideration was also issued. On that it means this date.
Yeah. That is why it's part of the fair value of consideration. Do you get the treatment? That's why it's part of the fair value of consideration. So meaning cash was not in this business.
But they are saying that none of the purchase consideration or the outstanding interest on the loan notes as at the end, like when they say consolidating,
has yet been recorded. And nothing I may say you ever recorded finance cost no. And nothing I may say the loan note 15,000 will be added in the balance sheet when we go to the balance sheet. Do you get a treatment? Because they've not recorded.
This question, I don't see why we should apply 3/12 on the finance cost.
When did you issue the finance cost? When did you issue the loan notes, the 8% loan notes?
As at the date of acquisition.
Which is what?
The first January.
Where is the year ended?
31st March.
So why will you charge full year interest if you have operated for only 3 months after the loan notes? Do you understand? The 8% is per annum, but you've issued the shares to the year end only 3 months. So if you are charging finance costs, you can't charge for full year. You have to charge for only 3 months. So if you are watching the rebroadcast, you can comment below with your questions, and I'm going to be answering all your questions for you, okay?
Hey, see you. Sorry. I didn't get that.
The drive is slow.
Ah.
I'm sensing the drive to be slow. Because even though the things I'm sending are much, she should be going. Yes. What time are you leaving? Why, you have already done your ticket, or you are
No,
driving?
we
You can go anytime.
I need to act on an app. Business.
Then you could go and come for the videos.
But we have no idea what I'm doing. I'm not training. This is where you're driving. I just say you. About hey.
Small videos also.
This is a full video. Yes.
To drive me, prepare okay. Then
Oh, we say 124 days.
How many, Papa?
124.
124, 128.
128.
Why is not?
Oh.
I'm woman.
Probably the word is
Hey, who's the
it's hard to see.
124.
124. Hey, there, bro. It didn't better natural. No name.
That's also the
So external driver, because external driver will be better. 250 cedis or so. That's around 350 cedis or so. So because we would get
and one so me copy idea is me
Oh, format to drive.
my format
in papa. Bomb. Iraq bomb.
The management accounting size.
It depends on what I have here.
The ones the short term decision.
You're not seeing it all.
I was in here like
But are you watching the videos?
on the bottom, I can't see that.
You don't see short term decision.
On the bottom, like I can't see the login.
Why? Lock mommy red. And I can't train it. Then I did out the same problem. I just solved it.
I see like I'm gonna show
If you're the finance course, the 300, why are you saying you send, but you send it to group retained earnings and then cash?
Group retained earnings because the parent is the one issuing the loan notes. So if you charge finance costs and expenses, it has to be taken to the income statement. So the group retained earnings is where we subtract it. Then it hasn't been paid yet because the debt now is almost recorded yet. So it goes to the liability. It means you've not logged in before. And I already feel password. I'm going to log in and make sure anyway. There's nobody else. Praise God.
Okay, I think I was looking at one question. Would the environmental cost or maybe any fair value adjustments? What they did was they subtracted if there's a depreciation. They subtracted as we have done. But the cost of the assets, they will write one for the acquisition and the same for the year end.
Send one 4,000. And a depreciation minus 200.
The provision 4,000 and some pound.
So, way a special scenario. Where they are all can here say your assets pair. But question when they decommissioning, which is an environmental cost. That is why two things are happening at the same time. That PP is happening and provision is also happening. One again. Jose, we're not getting the link. So let's go to the website. That's what Glow. That network is there. I didn't know it's there.
It's all about the manager.
I've forgotten that we are having life.
Well, my manager is the best.
Glow.
Glow.
It's the best.
Oh, we did that was
Where are we? Where are we?
Why don't you do it bit by bit? Don't copy all at a go.
21%. And I'm copying like 3 sets of videos. So see PSA. Oh now they are okay kind of make copy.
That's it.
And the way PSA. We say we do 80%. Yes. It's the FR no na. So it's going. It's going. I didn't know Blue is there.
A class.
Since I want to do one,
Hey.
oh, because I don't know any teacher. No. But it works where, like in your house. It's strong.
Oh, yeah, good.
It's good. Why you say it's good like that? Is it a data back there?
Yes. I use it for course. No one, I didn't video the number myself,
But the data.
And it's fast.
Don't come off his okra. Make you pyra. Oh, me more than pyra.
And it's working.
You try to do it.
Abari, say the other blue and say, "Oh, say, call you man, call you man."
Hey. Oh.
So comment below with your questions. We are solving a question on consolidated statements of financial position. So comment below with your questions. I'm leaving a comment below with a link to the question so you can download. Kingsley Edu. I'm sure it's your man. Watchro hello say. Hi Kingsley. I believe you are enjoying the class. We are solving a question on Digent. I trust you have it already, so you just refer to the solutions we have here. I'm sure he's the one, Kingsley. Okay. So you go million dashboard. Let's go down. Go shoot. It's like you're running it slowly. Today I even know.
As compared to the phone that you use, this one is
Oh, this one is better. Like, I've tried all other things in here.
Oh, Mrs. You are the best.
Empty your words for your question.
Oh, yeah, it's nice.
But the glow is better.
Yeah.
Hey, and the glow for it. Essentially, I say,
Just that, like, the only thing is that light out. It's never like light out. It goes down.
Do they use PDS to color?
It's light out for your area. Then the data will not count.
What are when you raise?
Okay.
What a shock.
Now, okay, that means Okay, but maybe they have a tunnel or something at your end there.
That is actually boosting.
That is actually boosting the network. So when the light goes off, almost all come off.
Like
I
my
say
friends
almost
like
all
this.
babies are almost empty plant. Anyway.
Maybe they are not aware.
Just come.
Yes, come. So, let me see every. Is that the only course you have? You're not having it. Okay, you're not having it. I think they will do the enrollment for you on there. I don't think that's okay. Okay, you press courses again, so unless you click on it. So scroll down to short-term decisions.
This one's boosting.
No, these ones are not
Why
bad.
do we not pay the finance cost?
But you must bring the drive and take the new videos as well. Okay. So let me finish.
But are we going to solve their work? Which one?
No. There is a mock we'll be doing. I have questions that will be solved. But if you are solving it and you have any problem,
I was going to the with my
Oh,
If
okay.
you are not a booster, why are you? I was asking why the finance cost? Why did it even come in?
Why what?
Why the finance cost? Not the 300 before that I asked. Why?
Finance costs because if you issue loan, you must pay interest. And we are told that the outstanding interest has not been, and the loan is not recorded. That is why we need to calculate. So what I've been stated in the first thing is what we look at.
Remember some time ago, the Intra-group trading, we subtracted some from the revenue and then cost of sales.
That is if you are preparing consolidated income statement, profit or loss. When you are preparing consolidated profit or loss, then the total sales must be subtracted from the income, the revenue and the cost of sale. But how we have position there as at the end numbers. Yeah. You can put it. There you go.
It's 2 minutes.
The PEP, apart from these two things, is there any other thing? Like the unsold goods in transit, are there any other types?
Unsold goods in transit. The third thing I spoke about was if they sell assets to each other. If they sell assets to each other and they make profits too, it will be called unrealized profit. Because they are not supposed to sell to each other and make a profit. Because the asset will still be used by the person who is selling the asset. So group-wise, it's still with the group. So unrealized profit can also come from disposals of assets.
The TPL is trade.
Trade receivables. So trade payables. And then inquire. Let me see. Little break. We'll break at That's how I charge you for. You know something? Let me give you USB cord. Say it's type C.
Yeah.
This
So we can use this.
authentic one. short na boy bi na from short. Boy bi na che long short. Issue man, the way to
Game man eko. Okay, then it's your system. And then you have the system above it. The Chinese system one. Stapler. That's it. Yes, you want to break up. Are you guys done?
Yes.
So is it a charger or the system? Maybe it's this. Can we go? Okay, so let's move on. We are done with the first 3 notes. So if you are watching the rebroadcast, this is a classroom setting. That's why you saw that we paused. We took a long time like that. It has to be reading, then we continue. So let's go to note 4. Now there's to solve for note 3. I'll say the intra-group reconciliation should be achieved by assuming that lateral co had received the goods in transit before the year end. One can't say so as I said all the time, that statement is just a fellow statement. So let's go note 4. The investment in Emrico, okay, that means there is another investment. Because if you go to the statement of financial position and the agent code, you can see investment in what? Emrico. So I'll say investment in Emrico represents 30% of its voting rights. And agent code uses equity accounting to account for this investment. That means that is what? An associate. So Emrico, if you go and adjust your group structure, Emrico. Okay? At what date? It's on the face of the financial statement. What date is there? First April 20x5. And what is the reporting date? Still 31st March.
Yes.
20x6. It is a full year. Full year. So they have full year profit. We will take what? 30%. Make sense?
Yes.
Okay. So go ahead. Adjust your group structure. That's what.
Where are you getting this?
Note 4. Go to note 4. So note 4. Emrico. So immediately I hear that, it's that we should use the equity method. Remember again. In this question, it's like the examiner is trying to be generous and teaching you what you are supposed to do. Once there, I'll say, Dagent code uses equity accounting to account for this investment. Even if they don't tell you, you should know we have to use what? Equity accounting. Because investment in associates, we use the equity method according to IAS 28. So investment in Emrico or Americo, depending on where you are. So that you can't talk about America. Well, guess what? What did we end up? Is it 4?
No, 6.
6. Hey, the great tracer. It will be 7. Okay. So cost of investment.
Ask. How did you know that Americo acquisition date is 1st April 25.
Go to the face of the balance sheet.
In the balance sheet.
Can't you see investment in America there?
The second sheet. First,
Investment in America.
Can't you see that?
No.
Oh. The first.
Is it the 1st April, this one?
No. First.
Investment in America.
Oh,
So what is the cost of the investment?
It's 31.
Hey, we said 31, we said 4,000.
It's 4,500.
4,500. Then what do we bring? Share of profits.
Yes. Which is.
I think from that note they gave us the information. Let's go and read it. Finish with it and read it. Americo's profit for the year ended 31st March 2026 was how much? 6 million. So share of profit, we will take 30% of 6,000. What we got? 1,800. Continue. And Americo paid total dividend during the year ended 31st March 2016 at of what? 2 million. Then I told you that the dividend they receive, we must subtract it. So 30% of 2,000 must be subtracted. What do we have? 600? So that is subtracted.
Sorry.
So the next figure is what we get for investment in America to be taken to the statement of financial 5,000.
So
78.
the 2,000 and the 2,000 is paid to other investors.
As well. But we own
Just the
30%. That's why we take only 30% of that. So that is investment in America. So that is what goes to the consolidated statement of financial position in that case. Now I think we are done. Note 5 says all profits and losses accrued evenly throughout what? The year. The meaning of that statement simply means do pro rata where you have to prorate, okay? It means like that is why the interest we did 3/12 and all those things we did that. Note 6, it says there were no impairment losses. Good news, that's all. We are done. Now, even though we finished going through the notes, there are some workings we need to do. So, workings 8, what do we do? Group retains earnings. Because we have prepared statement of financial position. Let's go. Give me agents retained earnings. Agents retained earnings. 16,000. Then we'll bring share of profit, but be careful. There was a PUP, provision for realized profit. Workings what?
Workings
3.
3, yes.
That was 800.
Oh, workings. Hey, That's
PUP.
working 6. Working
6.
800.
How much?
800.
That should be subtracted. Then, what else did we say we bring? Finance cost. How much? Workings.
That workings 3. 300.
Okay. 300. That's also subtracted. Now listen to what I'm about to say carefully. If you look at Emery's score, that is Ivy, the last sentence, it says Digent Co has recorded its share of the dividend received from Emery Co in investment income and what? Cash. Meaning, Anchor we would have brought share of profits 1,008 no ha. Nemo 600 no omo jigada. I recorded as investment income, meaning the 600 is already included in their what? Retained earnings. So the only thing that will come here is the unrecorded share of what? Profits. This is something you need to understand, very important. They've received this money already. And Kaono Njia, we would have brought what? The 1,008. But you say, how much is 600 way than that? It says here, the net effect is going to be the dividend, the earnings of 6,000 minus the dividend of 2,000, and we take 30% of that. And that's just this minus this, and that's 1,002. Do you understand?
What
Is that?
when we take
I should go over.
1,008, then we take the 600 out of each page.
It's 1,002. Now, this is their share of profits. That is what should have been brought here. But the examiner said, Diligent Co has received the dividend, and they have included it in the investment income as well as in what? Cash. Now, where is investment income? Investment income is in the income statement, profit or loss account. Meaning this retained earnings for the year, their profit for the year, they have already included what? This 600. So when we are bringing share of profit from the associates, we will only bring what? The difference. We can't bring the 1,008. What is 1,008 in the bar? You've done a double entry. You've done a double accounting, and that's wrong. And this is what I want you to understand carefully. It is because of the final sentence there. That is why we are doing the 1,002. If not for the final sentence, we would have brought the 1,008. Are you okay now? Okay. So what is your concern? Bring what is on your mind and let me deflate it.
We are trying to record the group dividends. So the share of profits will come.
Yes. What did you give me here? Are you giving me Diligent's retained earnings or Diligent's? Are you sure this is 16,000? Because for my pro forma working, I'm not supposed to get 16,000. Who is giving me 16,000? Is it 16,000? From the question. Is it 16,000?
For the year ended, right?
It's 6. Is it 6,000?
What do you want now? Group retained?
No, then group retained earnings.
For who?
For parents, because we are dealing with group retained earnings.
It's 20,000.
20,000 is at the start of the year, and the profit they made for the year is what? 16,000. So you add the two, it becomes what? 36,000. Are you getting it? Because we said group Diligent's retained earnings, so we must bring the at acquisition and what for the year. Now, come with your question now. About this. What is your question? You said we are trying to.
I still don't understand why we are
doing that.
The dividend from the share of profits before we record it.
Like in the group retained earnings.
Yeah, I don't understand.
So you understand this side.
Yeah.
You understand this, but you don't understand why we are bringing 1,002 and not 1,008. The reason is because of the last statement there. Let's read the last statement again. It says, Diligent Co has recorded each share of the dividend received from Americo in investment income and cash. It is under 1,008 when you now they say about, but 600 no, I'm not recording that. It's part of their investment income, which actually leads to the profit of the year of 16,000. Now they cut 20,000 to get what? The 36,000. So if we are now preparing group retained earnings, we will be wrong if we will include 1,008 and the dividend that has been what? Received. That is why we have to deduct the dividend received from the total share of profit, and the one that has not yet been recorded, one that has not yet been accounted for, which is 1,002, is what we bring. So this is a special case. If not for the last sentence there, we would have just brought what? The 1,008. Does it make sense? Okay. Now, finish with this for me. Net asset at acquisition. Give me the answer. Get my tax place here. Oh, jeez.
Please, that dividend, is it dividend paid?
Which dividend?
The one at the top. It's investments in the associates. Is it dividend paid or received?
Go back to the question and let's see. It says Americo did what? Have you seen Americo?
Americo's profit for the year ended 31st March 2006 was 6 million. And Americo paid total dividends.
So if you have investment in a company and they pay dividend, what does it mean?
Yes.
It's Americo that paid the dividend. And we are preparing investments in America.
Yeah.
So he paid. So it's to be dividend paid.
No, relax. This is not, and we are not preparing an account for America. We are preparing an account for our investment in America. This is the cost of our investment. Per our profit, this is our share. Now, from our share, how much dividend way that it's free to get the value of our investments now at America. Do you get the idea? So yes, they are paying dividend, but we are receiving. But this is not in America's book. This is in our books. What do we have?
45,000.
45,000. Confirmed by somebody?
What is it?
I'll say 45. The same thing, right? And then the year ended. Now look at something here. Look at something here. The profit for the year, as we brought 9/12 here for the 8,000. Give me the year ended and let me see. 4720 at year end.
Yes.
Now let's see if we can confirm whether we are right or wrong. Can I clean this guy?
Yes.
Sorry. Now, the way you get post acquisition, listen to this carefully. The reason I'm about to do this thing is that it's simple to be done. Many students struggle with this. So what I'm about to do is very simple to do. So the way you get post acquisition profit or loss. Look at it. You need to bring the profit for the year. What is the profit for the year for Lateco? For the year, 8,000. Is it 8,000?
8,000.
Now follow me carefully. 8,000, but how much are we participating in? 3/12, which will give us, is it 2,000?
Yeah.
2,000. TNE. Then we did some fair value adjustments. The finance cost, we said it has to be deducted because it hasn't been deducted from their profit. So fair value adjustment, finance cost. How much we got? 80 and not 28. Then depreciation, how much?
200.
Tifring. This is the post acquisition profit. 1720. Now, why did I do this? I did this because this should be their post acquisition profit. But if you look at what we did here at acquisition at year end, we are actually getting post acquisition loss. I don't know if you see it. You see that acquisition is more than the year end.
Sure.
Which means, so in the morning when we're solving, I have the same issue, which means there was an error somewhere. So I'll look for it and deal with it for you. But that is why I did this for you as well. So that you'll be able to get what? Your post acquisition problem. Because usually, what we get here, the difference should be the same as what? This figure. But it's not the same. So just in the morning I told them about it, so we're just going to be leaving it like that. But the at acquisition is correct, we're going to be using that for goodwill. You remember that? I told you at acquisition we use it to calculate goodwill. Then this post like trade gross profits. What do we have? 1720. How many percent we owe? 75%. What do we have? Who said the year will have a 3/12? The year will have a 3/12. So oh yo. And the baby Benham. So let's go. 75% of this. What do I have? Okay. Is that all for group retained earnings? Was there any impairment?
No.
Okay, so it means that's all for group retained earnings. So add it up for me. This is what goes to the equity for group retained earnings.
$37,390.
37. 390. Okay, so that's it about that. So finish writing and let me. I need to calculate goodwill. But you already have this, right? Only the totals. So just put the totals down because you already have everything here. Just put the totals down. Because I want to calculate goodwill there. And now, there are two more workings to be done. Goodwill and then NCI. I don't know. So you will be doing it. So, goodwill. Goodwill, but I say, let's go. What is the fair value of consideration transferred? We did workings for that. What do I say?
47.
Workings. Okay. Fair value of NCI. Workings. What do I say?
Can we calculate it?
Yes.
Okay. 9,000.
9,000. Workings 5.
Workings 5. So give me value of the business.
That was working as 4. 4.
So give me goodwill. Sweet, simple, straight to the point. That's a goodwill. That's a goodwill. So this will also go to the Consolidated Statement of Financial Position under non-current assets. Okay? Remember, this is also under non-current assets. Then the last workings, then we can now put the pieces together. Workings 11. NCI at the reporting date. What was NCI? Remember the profit was how much? 1720. Their share is what? 25%. So give me that figure. $430. So we go. NCR, the reporting date. 9430. So that will also go into equity. That's it about that. That's it about that. Now, there is something that I didn't do. It actually escaped me. I just remembered. When we say share exchange, we have to split it into two. We must split it into the stated capital component and then the share premium component. TNE. That thing escaped me when I was explaining. I'm cleaning up here because you have good structure already. So just go to where fair value of consideration transfer, the share exchange, and let me explain what is there. Now, how much did we get for the share exchange? How much did we get? It was 75% of what? 20,000, 2 over 3. Am I right? Was that a share exchange policy?
Yeah.
So if you do this, what is the number of shares you get?
We did not add the price.
Yeah, I'm not bringing the price yet, but just give me the number of shares from the share exchange.
$10,000.
10,000 shares. Now listen carefully. This shares was sold at a price of what? 3.2. NMI now 32,000. When you go to the balance sheet, you realize that the nominal value of the share is how much? $1. It means you must split this into two. Part of it will go to the share capital or equity, and part will go to where? Share premium. If this was the price, that means $1 times 10,000 will go to share capital, then 2.2 times 10,000 will go to share premium. Do you understand? So you don't bring the whole 32,000. And yes, sir, you are not taking into consideration the nominal value. So $10,000 will be for stated capital, $22,000 will be for share premium. So when you go now to the balance sheet, remember, share capital, we only bring the parent. Into the 50,000 above, now the 10,000 account. Then the share premium, there is none here, but you will bring a share premium of 22,000. This is the answer to the question. The various working team must do.
Yeah, then we can take it.
Yeah.
The format we give us. We need to bring a share of profits from subsidiary. Share of profits from the associate. The associate is not getting it.
Sure. No. Who is the associate? This is the associate.
Who is the subsidiary?
Is it?
Who is the subsidiary?
Latreco is the subsidiary called
And Ameri, yes.
Ameri is the associate.
So where is the associate then?
Unrecorded share of profits, associate. And then I enter 1,002. That's the 1,002 for associate. And share of Latreco's profit. Latreco is the subsidiary. And that's what we did here. We take the 75%. I don't know, but what piece is that? And this drive is. The drive is also Toshiba. Maybe it could be faster on the left.
Oh, Mrs. Say it faster. About to see that.
It could be faster on it.
And
I didn't know the way you're there.
oh, yes. but if we have a friend up where so with some very nice Mrs. in Kauka.
Thank you for now. In case we do.
Tell you our estimate and then come on, me for my chief or Richina as a mentor, but still as a mentor. Another wife, why is it? Yeah, too. Oh, I'm proud my age.
Somebody you know that person who is.
Oh, yes, come on, I need using my guy. Yeah,
So, can you tell me so that
also on 25.
out of
Also on
your
25. Can you be like 25?
and then,
put it on here. All right, so we put the pieces together. Somebody asked a question there. That is, forgive me if I don't pronounce your name well, okay? Adedoyi Abiodoye. Forgive me if I don't mention it well. You said, how do you get the questions? The questions will be available in the description box as well as in the comment box. So click on the link and then you can download the video on my Google Drive. Hey, did I say video? You can download the question on my Drive. So let's now go to the statement of financial position. You have the workings already. Until when I say something, you go get it and you bring it to me. So property, plants, and equipment. Let's go. Please, when you're writing, write it in full. I don't have space. That's why I'm doing shortcuts. Parents. Parents. 75.
200.
Subsidiary.
31,500.
Do you remember the adjustment that must be here? The PPE 4,000 and then the depreciation of 200. Do you remember that? Okay. So give me the next. That will go here. What's the next thing? What's the next thing?
Goodwill.
Goodwill. But before then, we can bring investment in Amery, right?
Summary.
From workings what? We did the workings for that. Workings.
7.
How much?
5,700.
Okay. Give me goodwill.
Goodwill.
Workings.
10.
How much?
11,000.
Okay. PPE.
110,300.
110,300. Give me total
500. 110,500.
500.
Okay. It's minus 200.
Yeah.
Yes. It's
Seems like 200 plus.
Who's the 200 you are?
yes.
And a 200
Yeah.
it's a punch your over. Maybe you didn't bring this 200. So give me the total.
127,200.
Give me current assets, inventory. Let's go.
Parents 19,400.
19,400. Subsidiary.
8,800.
What did we say we adjust here? Goods in transit. 700.
Yeah.
And then provision for realized profit. How much? 800. So give me the net. I hope you are getting the treatment. So we are just completing the entries here. After inventory, what do we have? After inventory, what do we have?
Receivables.
Trade receivables. Parent.
14,700.
Subsidiary.
12,500.
Intra-group. 3,000. Do you remember that?
Yeah.
So you give me the net. What else do we have there?
Bank.
Parent. Subsidiary.
600.
Assuming there was cash in transit, would have added it. But here there's no cash in transit. Respectively, please.
38,100.
For who?
Inventory.
We go.
$24,200 for what's it called?
Add it up and let's get total assets. Add it up to the top. Let's get total assets. 191. Then we need to continue with equity and what? Liability. My space is exhausted, so I'm doing that here. But we'll try. Let it continue. So equity and liability. We go. Equity. What did we say we bring? Equity shares. What is the parents own? You know it is the parents in one ever. How much?
15,000.
But remember the share exchange. You remember that? We said we will bring how much here? 10,000. Okay, so we added up and that will going to be.
So that's an idea.
What you say?
So that's an idea.
Share premium. How much did we get? 22,000. Retained earnings. Workings. 37,310. Workings. Or no workings number.
There's a number there.
Retained earnings.
Yes.
Don't try. Someone of name workings.
Yeah.
Give it total there and let's bring non-controlling interest. Non-controlling interest, workings. Never when you have a true workings number. I didn't know my main. Non-controlling interest, how much did we get?
94.30.
9 for workings.
Okay.
Workings 11.
For who?
Non-controlling.
Okay.
And the retain, group retain, right?
Uh-huh.
Which is 37. Was it 37? 390 or 30?
It's 390, yeah?
Yes. Yes, workings 8.
Should it be 390? Yeah, it should be 390. Maybe I didn't write one.
It's 390.
It's 390. Add it again and see. So arithmetically, please. And so it's just this, right? Is it 390? It's 390. Okay. Liabilities. What are the liabilities? Quickly, fill me up.
8%.
Non-current liability first.
8%.
8% loan notes. How much?
Parent is 5,000.
Subsidiary.
No.
Nothing. But remember the issue, consideration, you know. So okay, 15,000 from workings what? 2. It has to come. Okay? So the 2 will add up to what? 20,000. Makes sense? Now, remember I told you about the finance cost we are calculating here on the 15% loan note. Remember I told you it should come under current liability? Now, if we were not told the time that the payment is due. Are you getting the idea? So we will bring it still, we could still bring it under current liability. So let's go. I think for current liabilities, there was current liabilities and kasa.
Yeah.
So current liability given, how much?
24,000 for parent.
24,000, subsidiary?
16,400.
16,400. Then we add this finance cost, how much? Was it 300?
2,300.
Oh. The first was BIA on the 8% loan note.
300.
300. That's what I'm talking about. You know, I told you you're supposed to come and not carry liability. That's where it is what?
Still 2.
Okay.
But it's 3. No one's with.
3. So add it up.
What about the PEP, the Intra-group trading?
Provision for realized profit. Anytime that you know about how no.
Yes.
Uh-huh.
The 2,300.
You can do what? Say, okay, say about. Say, also, I'm my current liability.
Yes.
So all those inconveniences must come here. So 2,300. That's workings. Okay.
It was under 6, working 6.
Okay. Now, I'm sorry the way I presented it. When you are writing, let it just be presented normally. So add everything up for me. Please add for me, let me balance out, please. What?
48,000 current liabilities.
So 63,000. So then you add all of them up.
390.
Where? Here? 119390. So add the 3 up. It should be the same figure, is it?
No.
Hey! And I don't see. Why not get go baby? It should balance.
This is Indiana.
We've not brought the provisions. Have you forgotten? The environmental cost. Do you remember? It was 4,000 plus the 80. And it will be 40 what? 80.
Yes.
So redo the workings for me.
67080.
67080. So let's see if it will balance now. Does it? Hey! I don't know who. Hey, Radhi is good to me. Is it like that? Are the figures punched like that?
The 67 and it's the same.
And this one too is the same. But then mommy go through my scheme here. 59,390.
Let's have the return.
914. Add this and this and let me see. And then 20,300 it's here. And then 4080 is here. Then 2,300 is it should balance. You guys are not punching well. Was it?
The same.
Now, who are you going to wear? How many are you?
That was 128,820.
128,820.
Yes.
Now add the 3-way maybe over 67.
The difference here is coming 195,900 minus
The
100.
record 61,740.
No, relax.
Some it's what I was
The error is here. The error is here. This 20,000 is correct. This 4080 is correct. Now this plus this thing is not supposed to be added. It's supposed to be subtracted. Say intra-group, no? The trade payable, no? It has to be subtracted. Do it again. Teacher, say Musumu. Shim.
Still.
124. Yes. 6,000.
Remember, the 300 was a provision.
What was the 300?
What was the 300 for?
The 300 is the finance cost, no?
Finance cost.
So it has to be added to the liability. It has to be added. Say accrued.
Right now, this is going to be 6,800.
What?
2,840.
Hey.
They say 2,840.
Aha. 28,400. Into added 300. Please confirm for me.
5248.
52,480. What are they? 919. Hey.
181,300. Difference of 8,000.
So which 10,000 are we not figuring out? Yeah, make sure I deal with it because the way I'm moving here. Me who they are money. 20,000 a year. No, above there is correct. The equity aspect is correct. The problem is here.
You said the 8% loan is 5,000 plus 15,000.
24,000 now.
To give you 20,000. Say 5,000 plus 15 is 20,000.
Yeah.
Then this and this will be 40, 80 is here. This 300 is here. I don't know why you are getting this figure.
No. It's the 6,400 is supposed to be 16,400.
Nhyira came. It's going to so 38.
What I can't say that I said we get the hour. I said
191. 300. So it will balance now, right? Because I'm seeing the things there, but the thing is not balancing. Come on, punishment, sir. Alright, so that is the balance sheet, okay? That's the balance sheet. Now, this is what I want you to note. Number one, the treatment of the fair value adjustment. Number two, the treatment of the share exchange with the addition and the share premium coming in. Number three, the bringing of the decommissioning or the environmental cost. Very important. And then the interest on the loan notes. That's 300. These are the things that you have to note about this question. So you can put it down and you ask me questions that you have. Right, so this is the question about agent code, and I would see you in another video as we discuss other things. I'll be leaving the link in the description for you to download this question and then look at it how we go through it. So thank you for watching, and I'll see you in another broadcast.